Welcome, everyone, to the Deep Dive. We take stacks of sources, unpack the really important nuggets of knowledge and insight, and basically give you a shortcut to being well-informed.
And today we're diving into a story that honestly stretches across pretty much all of human history. It's something that affects every single one of us every day.
It really is.
Yeah.
It's a story about something fundamental, isn't it? Debt, trust, how money flows, and how that's all changed over thousands of years.
Yeah, exactly. And to really get a feel for it, picture this scene from the 13th century. You've got the Latin Byzantine Emperor Baldwin II, right? This is 1237.
Okay.
He's so desperate for cash, he has to use the crown of thorns.
Yeah.
You know, the one believed to have been worn by Jesus as collateral.
Wow. The actual crown of thorns. Pawned.
Pawned for a loan of 13,000 per peri from a Venetian merchant. It's this incredibly dramatic image of how desperate rulers could get and how central credit was even then.
That is arresting. A holy relic for cash. And as we'll see, this wasn't just some weird one-off thing. It really shows how credit and interest have shaped history in some pretty surprising ways.
Absolutely. And our main guide for this journey today is a truly monumental piece of work. Sidney Homer and Richard Silla's A History of Interest Rates.
Right. This book is massive, covering 5 millennia from ancient Sumeria right up to the early 21st century. It's packed with financial drama, amazing facts.
It really is a treasure trove.
So our mission in this deep dive, using Homer and Scylla, is to explore, I think, 3 main ideas. First, what interest rates are, fundamentally, and how they've changed through history, and how they often act like a kind of thermometer for how a nation's doing.
Right, a thermometer for economic and political health. That's a key concept from the book.
Second, we want to look at this fascinating long-term trend, why, for centuries, interest rates seem to be mostly heading downwards.
Yeah, that long decline is a huge part of the story.
And finally, we'll get into how people got creative, sometimes really creative, maybe even controversially, to get around rules, like the medieval church's ban on usury, just to keep credit flowing. Because, society needed it.
Couldn't function without it, really, even with the rules.
Exactly. And we'll wrap it all up by thinking about this provocative historical claim about interest rates being linked to a nation's cultural level, and whether that idea still makes any sense today.
That Boom Bauer quote. Yeah, that'll be interesting to unpack in our modern context.
Okay, let's start at the very beginning then. The essence and evolution of interest rates, and this idea of them being a historical thermometer. It's so easy to think of credit as like a modern thing, maybe even a bit of dirty word.
Right, or something that came with banks and Wall Street. But the evidence Homer and Scylla present just blows that idea out of the water.
How far back does it go?
It's genuinely ancient. Credit predates coinage by over 2,000 years. We're talking about old Sumerian documents, okay, from around 3000 BC. That's 5,000 years ago.
5 millennia.
And these documents show a systematic, organized use of credit. It wasn't just borrowing a cup of sugar, it was embedded in their society.
So what did it look like back then, if there wasn't even coinage?
Well, think about the absolute basics. A Neolithic farmer lends some seed grain to his neighbor. He expects more back at harvest time, right? That more is the interest, the yield. That's the core concept.
Primitive interest.
Exactly. And early money wasn't necessarily coins. It was often commodities, what they call money in kind. Grain, animals. It's actually why the Latin word for money, pecunia, comes from pecus, meaning cattle.
Ah, that makes sense. It shows how fundamental these exchanges were long before standardized money.
Precisely. And, wherever you have credit, you eventually need some rules, you need regulation.
Because things can go wrong, people don't pay back, or lenders get predatory.
Exactly. And the earliest formal code we know of that really tackles this debtor-creditor relationship is Hammurabi's Code from Babylonia around 1800 BC.
Nearly 4,000 years ago.
Wow. And it wasn't just a few suggestions, it was incredibly detailed. For instance, it set maximum interest rates.
Really? What were they?
Get this. 33.33% per year for grain loans, which you'd pay back in grain, and 20% a year for silver loans, paid back by weight.
That's surprisingly specific.
And it required written contracts, witnessed by officials. This was serious stuff. It underscores just how formalized it was.
What happened if a lender broke the rules, tried to charge more?
The penalties were severe. If you tried to collect more than the legal rate through some trick, like, say, inflating the principal amount or using dodgy weights, The penalty was the complete cancellation of the principal.
You lost everything, the whole loan.
The whole thing. A massive disincentive to cheat. Plus, it even put limits on personal slavery for debt, capped it at 3 years. So you couldn't be enslaved forever just because you owed money. It tried to balance things.
That's an amazing level of sophistication for that long ago. What about the Romans? They're famous for law.
They were grappling with the same issues, definitely. Their famous 12 tables, codified around 450 BC, actually look quite a bit like Hammurabi's code in some ways.
How so?
They also set an interest limit. It was called unciarum fonis, which works out to about 8.33% per year.
Lower than Babylon's rates.
Yes. And if you charged more, the penalty was fourfold damages. You had to pay back 4 times the excess interest you collected.
Ouch. Did they still have debt slavery?
They did, unfortunately. That was still allowed under Roman law, a pretty harsh reality. But interestingly, the 12 tables did include rules about the slave's physical well-being. So even in that dire situation, there was some legal oversight, some protection.
It's clear these ancient societies knew that credit was powerful, but also dangerous if it wasn't controlled somehow. But, okay, those are the legal limits. What were rates actually like in practice? Were they always within those boundaries?
Oh, absolutely not. Ancient rates could be, well, all over the map. It really depended on who was lending, who was borrowing, how desperate they were. Supply and demand in its rawest form.
Give us some examples.
Okay, so you had temples acting as lenders. The temple of the god Shamash in Sippar, Babylon, his priests loaned silver at just 6.25%. That was seen as like pious charity, almost a public service.
That's surprisingly low.
But then you contrast that with the Temple of Arbela in Assyria, purely commercial operation. They charged 25%.
Quite the difference. What about outside the temples? Regular commercial loans.
All sorts. Demosthenes, the famous Athenian speaker, 4th century BC, he charged 12% on some late legal fees. That was considered kind of the top end of the normal range in Athens at the time.
Okay, 12% sounds almost modern in a way.
But then you get the shockers, like Brutus. Yes, that Brutus. Caesar's friend turned assassin.
What did he do?
He tried to charge the entire city of Salamis 48% interest on a loan.
48% to a city?
Yes. Even though Cicero, the famous orator and statesman, basically told him, hey, the legal limit back in Rome is 12% and you can easily get money there for 4%.
Yeah.
It just shows how powerful figures could try and leverage their position.
Talk about using your influence. That's basically loan sharking on a state level.
And speaking of loan sharks, they were definitely around back then, too. Classical Athens apparently had them charging 48% a month.
A month? That's, what, nearly 600% a year?
Uncompounded, yeah. 576%. And the philosopher Theophrastus even wrote about someone charging 25% a day.
Per day. That's astronomical. Over 9,000% a year.
The book does caution that might be a bit of literary exaggeration, you know, for effect, but the fact that such figures were even conceivable tells you something about the extremes people faced.
So why? Why were these rates sometimes so incredibly high? Was it just pure risk?
Well, that's the common assumption, but Homer and Scylla argue it's maybe overstressed. We need to remember what ancient loans were typically for.
Right. What was their nature?
Mostly short-term. A few months, maybe up to 3 years max. Rates were often quoted monthly because that's how they were paid. And crucially, you weren't generally borrowing to finance like a huge factory or a 20-year infrastructure project.
So no big capital projects.
Not typically funded by credit, no. States rarely borrowed from their citizens in a systematic way, and there were no big corporations needing massive long-term investment. Credit was mostly for consumption, for trade financing between voyages, or for personal emergencies.
Okay, so mostly short-term needs. But still, those high rates.
The book points out that lenders often demanded huge security margins. The loans were short, and the penalties for default were incredibly severe. We mentioned personal slavery. Plus, the legal standing of creditors in Greece and Rome actually got stronger over time. They had ways to enforce repayment, just like under Hammurabi.
So it wasn't just risk driving those crazy high rates.
Risk was definitely a factor, no doubt, but maybe not the only factor or even always the main one. There was often just a desperate demand for credit and a limited supply of capital available for lending, especially liquid capital. It wasn't always easy to turn land or goods into cash to lend out.
Okay, that makes more sense. It's a complex picture.
And this leads us right into one of the core ideas from Homer and Scylla, this thermometer concept.
Right, the idea that interest rates reflect a nation's health.
Exactly. They argue that a nation's free market long-term interest rate, if properly charted, provides a thermometer of that nation's economic and political health. You can literally see major events, wars, instability, disasters reflected in the ups and downs of interest rates over time.
Like a fever chart for a country.
Pretty much. When a nation is strong, stable, growing, confident rates tend to be lower. When it's in turmoil, decline, facing collapse, rates tend to shoot up.
That's a really powerful metaphor. Can you give us a clear example from the ancient world where this thermometer was clearly working?
Mesopotamia is a perfect early case. After it lost its independence, got conquered by the Persians around 539 BC, its civilization started to fade. And what happened to interest rates?
Let me guess, they went up.
Sharply. The common rate rose to around 40%. This wasn't just a market blip. It reflected a deep loss of confidence, a breakdown in order, economic vitality draining away. And at the same time, where was the economic action shifting? Exactly, westward to Greece, which was on the rise. So you see this inverse relationship. Mesopotamian civilization declines, its interest rates spike. Greek civilization rises. Its rates, though still variable, were generally lower and reflected a more dynamic economy. It's a powerful illustration of the thermometer concept right there in antiquity.
Okay, let's jump forward quite a bit now into a totally different world, the Middle Ages. Here, another massive force comes into play, shaping everything to do with money and lending the church.
Oh, absolutely. The medieval church and its strict doctrine on usury completely dominated the financial landscape of Europe for centuries.
What exactly was the church's stance? What did usury mean to them?
It was incredibly strict. They defined usury very broadly as basically taking anything more than what was originally given in a loan. Any profit you made just because time passed was considered usury.
So any interest at all was forbidden.
Pretty much, yeah. It was considered a grave sin, a form of robbery, actually, violating the seventh commandment, thou shalt not steal. This wasn't some obscure theological point. Scholars and church councils debated it endlessly from the 11th century on. The Second Lateran Council in 1139 really formalized the prohibition. St. Augustine even said mental usury, just expecting to get back more than you gave, was sinful, the intention itself.
Wow. That sounds almost impossible to work with if you're trying to run a business or finance anything. How detailed did these rules get?
Very detailed. Pope Eugene III, for example, specifically condemned mortgages, where the lender got to keep the income from the pledged property, like the crops from a field, without that income reducing the actual loan principal.
So you couldn't just profit from the collateral indefinitely.
Right. And Pope Alexander III declared that selling something on credit for a higher price than you'd sell it for cash was also usury.
So no marking up prices for deferred payment.
Exactly. And the consequences for being a manifest usurer, someone openly known to be practicing it, were severe. Excommunication from the church. You'd be required to make restitution, give the profits back, just like a thief. The fear of this sin, the fear of eternal damnation, it really weighed heavily on people's consciences, from kings and bishops down to merchants and bankers.
So connecting this to the bigger picture, this deep-seated fear didn't just stop lending altogether, did it? Society still needed credit.
No, it didn't stop it. But it forced people to get incredibly creative. Governments, merchants, they all had to find ways to finance things, trade, wars, infrastructure, without technically committing the sin of usury. It created this huge intellectual and financial puzzle. How do you move money and extend credit when charging interest is forbidden?
This is where the story gets really interesting, right? The evasions, the workarounds.
Exactly. Usury wasn't eliminated, but it was ingeniously circumvented. And this is where medieval finance started developing some truly foundational tools that we still recognize today in modified forms.
Okay, so what were these clever methods?
One of the absolute key innovations was the bill of exchange. This was brilliant because, on the surface, it wasn't framed as a loan.
How did it work then?
Okay, typically a merchant in, say, Florence would give local currency to another merchant or banker. In return, he'd get a bill, a piece of paper, promising payment at a later date in a different city, say Bruges, and in a different currency, Flemish pounds.
So multiple currencies and locations involved.
Crucially, the profit wasn't called interest. Instead, it was disguised within the exchange rate used for that future payment. The rate would be slightly less favorable than the current cash rate, embedding the lender's profit. Because future exchange rates could fluctuate, the profit was presented as variable, speculative, a payment for risk and service, not just for the passage of time.
Clever. So the interest was hidden in the currency exchange.
Pretty much, yeah. concealed in an exchange rate higher than would have prevailed in a pure cash deal. This allowed merchants to transfer funds across Europe, extend credit for trade, all without explicitly charging usury.
And these were complex deals.
Often involving four parties. You had the remitter, who bought the bill, the taker, who received the cash and wrote the bill, the payer in the foreign city, who would actually pay out, and the payee, who received the funds there. This whole system spurred the growth of organized money markets in cities across Europe. Even the Pope used these bills extensively to move church funds around. The fees might look moderate, but the real profit was in that exchange rate differential.
Okay, bills of exchange. That's one major innovation. What else?
Another hugely important one was the annuity, often called a census contract, or, particularly in France, a rente.
How did annuities work around the usury problem?
These were long-term arrangements. Someone would give a lump sum of capital, say, to a city government or a landowner. In return, they wouldn't get their principal back necessarily, but they'd receive a fixed annual payment, often forever or for a very long time.
A perpetual income stream.
Exactly. Since the payment was seen as buying a share of future income, like buying rent from a property, and not as repayment of a loan with interest, it generally wasn't considered usury. These typically had lower rates than risky short-term loans and were the clear ancestors of modern government bonds or funded debt.
Any famous examples?
Venice's prestiti are a classic case. These started as forced loans on wealthy citizens to fund the state, but they paid a steady 5% annual income. They became incredibly popular, seen as super safe investments. People all over Europe, even princes, bought them. They were used to fund charities, provide dowries for daughters, because they were reliable.
Incredible how these tools just emerged from the pressure of the doctrine. But even with these clever workarounds, actual interest rates, when you could find them, could still be sky high in the Middle Ages, right? Especially for certain borrowers.
Oh, definitely. The evasions didn't mean cheap money for everyone. Jewish money lenders, for instance, often excluded from other trades and sometimes exempt from Christian usury laws, played a vital, if often difficult, role. They might charge around 43% even with good collateral.
43%. Wow.
And if the security was poor, rates could hit 80, even 120%. Even powerful rulers felt the pinch. Emperor Frederick II, a major figure, often had to pay his bankers 30 to 40%. Italian and commercial rates for merchants were maybe 20–25%, but Lombards lending to desperate individuals could charge 50–100%. Standard pawnshop rates hovered around that 43% mark, too.
It sounds like a very fragmented market with wildly different rates depending on who you were and how desperate you were.
Absolutely. The book mentions French legal maximums that ranged absurdly from about 22% all the way up to 173%, and records of Nuremberg Jews borrowing at 94%. It shows the intense need for credit.
And this brings us back to Emperor Baldwin II of the Crown of Thorns. That really highlights the unique risks of lending to rulers, doesn't it?
Perfectly. That 1237 loan is classic princely finance. A ruler's credit back then was incredibly personal and precarious. It depended entirely on their power, their health, their success in war. If the prince died, or lost a battle, or just decided not to pay, the lender might have no recourse.
Unlike lending to, say, a city.
Exactly. A town like Venice had continuous tax revenues, established procedures. Merchants had assets you could seize. A prince often couldn't bind his successors or even his own subjects reliably. Default was a real and frequent risk for lenders to sovereigns. That's why they demanded such high rates, or incredibly valuable, easily sellable collateral like the Crown of Thorns.
So princely credit. High risk, high rates. Merchant and town credit.
Yeah.
Lower risk, generally lower rates.
That's the general pattern. The Countess Jane, a powerful noble, could borrow at 18% because she had good collateral and more reliable income streams than maybe a campaigning emperor. It shows that even within the elite, credit quality varied massively.
Okay, so the Middle Ages were complex, strict rules, but also ingenious ways around them, and still very high rates for many. How did this finally change? How did the usury doctrine start to lose its grip?
It was a gradual process, but the Protestant Reformation in the 16th century was a major turning point.
How did that impact views on interest?
Well, especially in Protestant countries like England and the Netherlands, by the mid-1600s, people started openly discussing the economic effects of interest rates, rather than just the moral ones. Thinkers like John Locke argued quite forcefully that the price of the hire of money, as he called it, was just like the price of anything else set by supply and demand, and you couldn't really regulate it effectively through law or religious decree.
A shift from theology to economics.
A huge shift. It wasn't seen automatically as sinful anymore, at least in commercial contexts.
What about in Catholic countries? Did they follow suit?
It took longer. The really decisive break in Catholic thinking came later, mostly in the 18th century. Arguments started appearing that civil law could make charging interest legal, even if the church hadn't formally changed its stance. And it wasn't necessarily a sin to take normal market rates, especially from the rich or for business purposes. State borrowing, which had always been tricky, was also increasingly defended as legitimate and necessary.
So the intellectual groundwork was laid for more open, modern credit markets.
Exactly. And you see this reflected in practice during the Renaissance and early modern period. Look at England under Queen Elizabeth I. The Crown was borrowing at 10% in London. That was the legal maximum, and it was enforced. Her agent, Sir Thomas Gresham.
Gresham of Gresham's Law. Bad money drives out good.
The very same. He was skillfully managing English borrowing in Antwerp, a major financial center then, getting rates of 12 to 14%. Still high by later standards, but manageable.
What about France? They seem to struggle more earlier.
They did. The French king tried to foster competition among lenders in Lyon, sometimes paying above market rates 12, 16%, even briefly yielding 28% just to attract funds. But it was unstable. There was a massive financial crisis in 1557 where both France and Spain basically defaulted, suspended payments. By 1575, French royal credit was pretty much shot.
A cautionary tale about sovereign debt even then. But you mentioned the Netherlands earlier. They were the real game changer.
Absolutely. The Dutch financial revolution is key. As the Dutch Republic gained independence from Spain, Amsterdam became Europe's undisputed financial hub. And they achieved this through what the book calls high modern standards of state credit.
What did that involve? How did they do it?
It wasn't magic. It was fiscal discipline,
Yeah.
reliable tax revenues, and crucially, an ironclad commitment to always paying their debts. Provinces, cities, the Republic itself, they built a reputation for reliability. Deep trust. Investors knew they'd get paid. And because the Netherlands was so prosperous from trade, there was a lot of capital looking for safe places to go. This combination, trustworthy borrower, lots of capital, drove their interest rates down incredibly low, sometimes just 3% for the government.
3%. Back then. That's amazing.
It was. And everyone else in Europe noticed, especially the English, who were often at war and desperate for cheaper ways to finance it. They looked at the Dutch model with envy.
And that envy led to
The creation of the Bank of England in 1694. This was a direct response, an attempt to replicate Dutch success. The government needed money for war against France, a huge $1.2 million loan.
How did they raise it?
They offered the lenders, the subscribers to this loan, an 8% annual return. But the real prize was that in exchange for lending the money, these subscribers got the right to form a corporation, the Bank of England. It was a revolutionary deal.
A public-private partnership almost.
In a way, yes. And the bank was hugely important. It didn't just provide that initial loan. It helped manage all the government's debt, created a liquid market for government bonds, stabilized the currency, and over time, it helped bring the cost of government borrowing down from that initial 8% to 6% fairly quickly.
So the beginning of modern central banking and organized national debt.
It really marks a turning point. Sound public finance, managed through an institution like the Bank of England, became a tool of state power and economic stability, paving the way for much lower interest rates in the future.
Okay, so we've traced rates from ancient times through the medieval theological debates and into the early modern era with the rise of state finance. Now let's tackle one of the book's biggest themes, this remarkable centuries-long downward trend in interest rates, particularly in the West.
Yes, this is what Homer and Scylla call one of the grand narratives.
Oh.
They really emphasize this pattern. First, they point back to antiquity, remember the thermometer. As ancient cultures rose and flourished, rates tended to fall. As they declined and fell, rates shot back up.
Right, we saw that with Mesopotamia versus Greece.
Exactly, that pattern holds. But then they focus on Western Europe and North America from the Middle Ages right up to the mid-20th century. And the overwhelming trend during that vast period,
Downwards.
consistently downwards most of the time. We're talking about minimum long-term rates going from over 8% in the high Middle Ages, steadily grinding down to below 2.5% by the mid-1900s.
That's a huge fundamental shift over centuries.
It's extraordinary. It reflects massive changes in economic organization, political stability, trust, and capital accumulation.
Can you give us some really concrete examples that show this decline in action, something iconic?
The absolute classic example is British consols in the 19th century. Consols were perpetual bonds. They paid interest forever, never matured.
The ultimate long-term investment.
Exactly. At the start of the 1800s, they were yielding somewhere between 4.5 and 6%. But over the course of the century, especially during the Victorian era, the era of Pax Britannica.
Peace and prosperity, relatively speaking.
Right. Global dominance, financial stability. The yield on consoles just kept falling. By the last decade of the 1800s, they were yielding below 2.5%.
Wow, so the price must have soared.
More than doubled. It was a golden age for bondholders. The absolute peak prices came in 1896-97, when the yield dipped to just 2.21%. Think about that, lending money to the British government essentially forever, for just over a 2% return.
Incredible confidence.
So much confidence that a leading editor of The Economist magazine actually wrote back then. Something like, for British consols to yield more than 3% in time of peace and prosperous trade is certainly abnormal.
They saw low rates as the norm.
The absolute norm for a stable, prosperous country. That quote just perfectly captures the mindset of that era.
Was this just a British phenomenon, though? Or did other countries see similar trends?
No, it was broader, definitely among the financially sophisticated nations. Look at Belgian rentes, their government bonds. They saw a similarly dramatic fall starting around 1848. Their 2.5% bonds actually doubled in price in just 2 years after issuance. And the yield difference compared to British consols shrank dramatically.
How much did it shrink?
In 1848, Belgian rentes yielded over 5 percentage points more than consols. By 1894, that gap was down to just 6 basis points, 0.06%. It shows how European capital markets were becoming more integrated and confidence was spreading.
And the U.S.? Do they follow this trend?
They did, although their financial history had more bumps. But they definitely hit a new low point for rates in the 1940s. Long-term taxable U.S. government bonds averaged just 2.31% during that decade. Now, that was influenced by specific factors like the Great Depression and World War II policies, but it fits the overall long-term pattern of rates reaching unprecedented lows.
Okay, so the trend is clear. But why? What were the big forces driving rates down over such a long period? It can't be just one thing.
No, definitely not. Homer and Scylla point to a whole constellation of interconnected factors working together over centuries.
What's the first major driver?
Fundamentally, it comes down to economic maturity and stability. This means developing strong, reliable institutions, what the authors call effective commercial ethics and laws. Things like dependable contract enforcement, secure property rights, plus governments learning suitable monetary and fiscal techniques and policies.
So building a trustworthy system.
Exactly, a predictable environment. When you have that, you get sustained economic growth. And that allows for the development of organized, stable financial markets where people perceive less risk in lending money long term.
And that stability builds confidence, right? Which must be another factor.
Absolutely. That's the second key driver,
Then
capital accumulation and confidence. As trade flourished, particularly from the 17th century onwards, and as people gained confidence in governments managing their finances, honestly, think back to the Dutch Republic example, huge amounts of capital were accumulated.
more money looking for a home.
Precisely. You had more savings, more wealth-seeking safe investment opportunities. When the supply of capital looking for safe borrowers increases relative to the demand from those borrowers, the price of borrowing, the interest rate, naturally falls. The rise of London as the world's financial center really amplified this, sucking in capital from everywhere.
What about the nature of money itself? Did changes there play a role?
A huge role. The return to specie payments, making currencies convertible back into gold or silver, and especially the widespread adoption of the gold standard in the 19th century were critical.
Why was the gold standard so important for interest rates?
It provided a stable anchor for the value of money. If investors believe that the currency they'll be repaid in will hold its value, that it won't be debased by governments printing too much or eroded by inflation, they don't need to demand a high inflation premium in the interest rate. Currency stability translates directly into lower nominal interest rates.
Makes sense. You're less worried about getting paid back in worthless money.
Exactly. And alongside these economic and monetary factors, you had crucial institutional developments.
Like the Bank of England you mentioned earlier.
Yes, and the whole evolution of funded public debt. Moving away from chaotic, short-term borrowing by monarchs towards issuing standardized, long-term, tradable bonds, often managed by institutions like the Bank of England. These institutions learned how to use a sound credit structure for national purposes. They introduced transparency, regular payments, disclosure, making government bonds much safer and more attractive.
Which reduced the risk premium again.
Right. It created a virtuous cycle. Better institutions led to more trust, which led to lower rates, which made it easier for governments to borrow responsibly, further reinforcing trust.
It sounds like this all culminated in an incredibly confident low-rate environment by the late 19th century. You mentioned a scarcity market in the U.S.
Yeah, that's a fascinating specific example. In the late 1800s, after the Civil War, the U.S. government was actually paying down its national debt very aggressively. They were running huge budget surpluses.
So fewer government bonds available.
Exactly. A scarcity of safe, government-backed assets coincided with huge investor demand for those very assets. This drove the prices of existing government bonds way up, meaning their yields plummeted.
How low did they go?
Some U.S. bonds issued earlier at 4.5% were trading at such high prices by 1882 that their yield to maturity was only 2.65%. Eventually, some bonds got so expensive as they neared maturity that their yield was effectively zero. It just shows how extreme the combination of fiscal strength and high demand for safety could push rates down in that era.
Okay, so that paints a picture of centuries of generally falling rates, leading to this period of remarkable stability and low yields by the late 19th, early 20th century. But then the 20th century happened, and that smooth downward trend seems to just break. The book calls it an age of volatility.
Yeah, that's putting it mildly. The extraordinarily high rates of the 1970s and 1980s in particular marked a massive change of direction, if not a discontinuity, from that long history we just talked about. It was a shock to the system.
What started to change things? Was it gradual at first?
Well, one major structural change happened earlier in the century in the U.S., the creation of the Federal Reserve System.
The Fed, established just before World War I, right?
Exactly, organized between 1914 and 1917. This was fundamental. The Fed pooled bank reserves, it created a lender of last resort, someone banks could borrow from in a panic, and it started using tools to manage the money supply.
How did that affect interest rates initially?
Its main effect early on was to smooth out those wild short-term spikes in interest rates that used to happen during financial panics. Before the Fed, a crisis could send short-term rates skyrocketing. The Fed provided a backstop, more liquidity. Interestingly, after about 1921, short-term U.S. rates actually started averaging below long-term bond yields, which was the opposite of the historical pattern. Generally, the Fed's presence tended to keep rates lower than they might otherwise have been in those early decades.
But then came the huge upheavals, the World Wars, the Great Depression. How did they impact this picture?
Massively. Both world wars and dealing with the Depression led to governments borrowing on an absolutely unprecedented scale. National debts ballooned.
And paying interest on all that debt becomes a huge burden.
Exactly. So keeping interest rates very low became an explicit political objective. Governments actively worked to suppress rates, sometimes called financial repression, partly to make borrowing cheap to stimulate the economy during the Depression, but also, crucially, to minimize the cost of servicing those enormous war debts. Low rates were policy.
But the real explosion, the period that shattered the old low-rate paradigm, came later, didn't it? The book talks about a revolutionary phase starting around 1965.
That's right. After decades of relative stability and low rates post-World War II, things started to unravel. You had the costs of Lyndon Johnson's Great Society programs, plus the escalating Vietnam War.
Big government spending increases.
Huge increases, often not fully funded by taxes. At the same time, monetary policy became more inflationary. And bond yields, which had been comfortably low for years, just started to soar. They reached levels nobody had seen in modern times.
And this was combined with other problems.
Oh, yeah. Rampant inflation became entrenched. The Bretton Woods system of fixed exchange rates tied to gold collapsed in the early 70s, leading to floating currencies and more instability. And then you got the nightmare of stagflation.
Stagnant growth plus inflation, the worst of both worlds.
Exactly. The economy wasn't growing much, but prices were rising rapidly. It baffled economists and policymakers, and it sent interest rates sky high as lenders demanded compensation for that inflation.
How high did they actually get? What was the absolute peak?
The peak came in the fall of 1981. The U.S. government, issuing 20-year bonds, had to offer a yield of 15.78%.
15.78%. on U.S. government debt.
The highest yield the U.S. government had ever paid in its two-century history. Imagine going from a world where 3% was considered abnormal to one where the government had to pay nearly 16%. It was a completely different financial universe, dominated by inflation fears.
That high-rate, high-inflation environment must have spurred a lot of changes in how finance worked. The book talks about an explosion of financial innovation and deregulation.
Absolutely. The old ways weren't working in this new volatile world.
Yeah.
So from the 1960s through the 80s, you saw this incredible burst of creativity, new financial instruments, new markets popping up everywhere.
Like what? Give us some examples.
Okay, deep breath. Negotiable CDs, letting banks raise funds more competitively, floating rate loans, shifting interest rate risk to borrowers, Eurodollar markets boomed, variable rate mortgages appeared, money market funds gave small savers access to higher yields. Then came interest rate futures and options for hedging risk, zero coupon bonds. Now W accounts combining checking and savings, foreign currency futures, mortgage-backed securities, completely changing housing finance, home equity lines of credit, IRAs changing retirement savings.
Yeah, okay. A whole new financial toolkit.
Pretty much. Each one was a response to the high rates, the volatility, the inflation, or ways to get around existing regulations that felt too restrictive.
And this innovation went hand in hand with deregulation, right? Breaking down old barriers.
Yes, particularly in the 1980s in the U.S. and elsewhere. For example, getting rid of interest rate ceilings on bank deposits regulation queue in the U.S. This reduced what the book calls the compartmentalization of markets.
Meaning money could flow more freely between different types of investments.
Exactly. Before, funds might be trapped in low-yielding bank accounts because of regulations. Deregulation let money chase the best return wherever it was. Arbitrageurs could ensure that rates in different markets, like the domestic U.S. dollar market and the offshore Eurodollar market, stayed very closely aligned. The spread between them practically vanished after 1990. It created a much more unified, efficient, global market.
And did this lead to people bypassing banks more? You mentioned disintermediation.
Yes, that was a big trend, especially when rates were really high. Why keep your money in a savings account paying 5%, if you were lucky, when you could directly buy a government bond paying 10 or 15%? Investors, even individuals, started going directly to the markets, bypassing the traditional intermediaries like banks and savings and loans. This forced the banks themselves to innovate to compete for funds.
This whole discussion about the 70s and 80s highlights something crucial for understanding modern rates. Inflation and real rates. You said before the 60s, real rates weren't a big focus.
Largely academic, yeah. Inflation was generally low and stable enough that people focused on the nominal rate, the number printed on the bond. But the persistent inflation of the 70s and 80s changed everything. Plus, cutting the link between currencies and gold meant there was no anchor. Suddenly, everyone had to think about inflation expectations.
Because the nominal rate doesn't mean much if inflation eats it all away.
Exactly. A 10% yield is useless if inflation is 12%. Your real return is negative. So market rates started explicitly incorporating an inflation premium compensation for expected future inflation. This made rates much more volatile, as inflation expectations themselves could swing wildly.
And this uncertainty led to another key innovation, inflation index bonds, like TIPS in the U.S.
A really important development. The UK pioneered them in 1981, and the U.S. followed with TIPS Treasury inflation-protected securities in 1997.
How do they work? How do they protect against inflation?
It's clever. The bond's principal value isn't fixed. It gets adjusted periodically based on an official inflation measure, like the Consumer Price Index, CPI. Then the bond pays a fixed interest rate, but it pays it on that adjusted principal.
So if inflation is 5%, the principal goes up 5%, and you get the fixed interest rate on that new higher principal.
Precisely. This guarantees the investor a known real return, regardless of what inflation actually turns out to be. It takes inflation risk off the table for the investor.
What are the benefits?
For investors, it's obvious protection against unexpected inflation. For governments, they might be able to borrow at a lower real rate because they're offering this protection. And for economists and market watchers, TIPS are incredibly useful because the difference between the yield on a regular treasury bond and a TIPS bond of the same maturity gives you a direct measure of the market's inflation expectations.
A window into the markets thinking about future inflation.
Exactly. They're a sophisticated response to the fundamental problem of inflation uncertainty that plagued the bond market for decades.
Speaking of broader trends, how integrated are global financial markets now? Do rates in one country affect rates elsewhere more than they used to?
Definitely. Global integration is a huge factor now, especially among the major industrialized countries. National money and capital markets are far more interconnected than they were, say, 30 or 40 years ago.
What's changed?
Fewer capital controls, better technology for moving money instantly, more global investment strategies. For much of the post-war era, regulations and frictions meant you could have quite different interest rates in countries with similar inflation rates. Now, capital flows much more freely, seeking the best risk-adjusted return, which tends to pull rates closer together. It's not perfect, but the linkage is much stronger.
What does this mean for emerging markets, places like China, India, post-communist economies? Do they just suck in capital from richer countries?
Well, economic theory suggests that capital should flow from places where it's abundant and thus returns are lower, to places where it's scarce and returns are potentially higher, like many emerging markets. This inflow should help those economies grow faster and over time tend to equalize returns globally.
Should. Does it happen quickly?
History suggests no. Homer and Scylla point out that even within the United States, it took almost 2 centuries for interest rates on things like mortgages to really become similar across different regions. So while the theory of global equalization makes sense, the actual process is likely to be very slow, bumpy, and affected by all sorts of national policies, risks, and market imperfections. Emerging markets definitely influence global capital flows, but it's not a simple, frictionless convergence.
And as we get right up to the end of the book's main time frame, early 2000s, there is a really interesting question, almost looking forward. Did the great bull market in bonds finally end around 2003? That multi-decade, even multi-century trend of falling rates?
They suggest it probably did. Their reasoning was that by the early 2000s, real interest rates, the yields on those TPS bonds, had hit rock bottom, historically speaking.
Why were they so low then?
Partly because economic growth in Europe and Japan was pretty sluggish. They weren't demanding much capital. That left the U.S. as the main engine of global growth, pulling in capital but also keeping global rates low. The implication was, if and when Europe and Japan recovered, the demand for capital would rise globally, and interest rates, both real and nominal, would likely start heading back up from those extremely low levels.
So the future path of rates depends on this complex global rebalancing act.
It seems so. It highlights how interconnected everything is now. Rates in one country aren't just determined by domestic factors anymore. They're influenced by global growth, capital flows, demographics, factors far beyond what economists were focused on even 50 years ago, let alone in Boom Bawerk's time.
Okay, let's bring it all together now. As we wrap up this huge sweep of history, let's go back to that really striking quote you mentioned earlier from the Austrian economist Eugen von Boom Bawerk, writing around the turn of the last century.
Right. He declared, quite boldly, the cultural level of a nation is mirrored by its rate of interest. The higher a people's intelligence and moral strength, the lower the rate of interest.
Higher intelligence and morality equals lower interest rates. That's quite a claim. What was the context when he said that?
It's crucial to remember when he was writing. This was the late 19th, early 20th century, precisely that period we discussed when long-term rates on prime government bonds in places like Britain and other developed nations were incredibly low, hovering around 2.5 to 3.5%.
Golden age of the bondholder.
Exactly. And importantly, significant persistent inflation just wasn't a major concern then. So in that specific environment, low interest rates really were seen as a badge of honor, a sign of a well-run, stable, trustworthy, prosperous society. It felt like tangible proof of national virtue and achievement. Boom Bawerk was reflecting that pride.
Okay, so in his time, it perhaps made a certain kind of intuitive sense. But if we take his statement, literally, low rates means high intelligence and morality, what on earth do we make of the 20th century? Especially those extraordinarily high rates of the 1970s and 1980s. Did Western civilization suddenly become less intelligent and moral?
Well, that's the provocative question, isn't it? It forces us to think critically about his simple equation. The wild roller coaster of rates we saw in the later 20th century, the volatility, it suggests that the thermometer is measuring something much more complex now.
It's not just national virtue anymore.
It seems unlikely to be that simple. It's probably reflecting the massive impact of things Boom Bawerk couldn't have fully foreseen. Truly globalized capital flows moving at lightning speed, the challenge of managing persistent inflation once currencies were cut loose from gold, the sheer scale of modern government debt, the effects of global shocks like oil crises or financial crises. Our modern challenges just add so many layers of complexity to what determines interest rates.
Does the book give any other examples that might complicate Boom Bawerk's neat formula?
It does. It mentions, for instance, Portugal, under its authoritarian Salazar regime, managing to keep interest rates artificially low for decades through tight political and economic controls. Does that signify high intelligence and moral strength in the way Boom Bawerk meant? Probably not.
Control isn't the same as virtue.
Right. Or think about modern Turkey, experiencing periods of extremely high inflation and correspondingly high interest rates. Does that mean its cultural level plummeted according to this metric? It feels like a very simplistic, even judgmental way to look at it. These examples show that rates are deeply affected by specific government policies, market structures, political systems, and economic shocks, not just some abstract cultural level.
So what's the takeaway then? Can low rates still be a source of pride? Do they still tell us something about a nation's health?
I think the book implies, yes, they can still reflect positive things, stable institutions, fiscal prudence, economic dynamism, but we have to be much more nuanced now. The actual level of rates is influenced by this whole complex soup of global factors, tax policies, central bank interventions, inflation expectations. It's not just a straightforward moral report card anymore.
So that leaves us with a final thought for you, the listener. If interest rates are this historical thermometer, maybe reflecting economic and political health, and if they once seemed to mirror something like national intelligence and moral strength, what do the extreme swings, the complex new financial tools, and the globally interconnected nature of rates today really tell us about the health, the wisdom, maybe even the moral fiber of our modern world?
It's a deep question. Are we just navigating a more complex reality? Or has the definition of economic health itself changed in a world grappling with unprecedented challenges? And maybe most intriguingly, what do those historically low real interest rates we saw in the early 21st century, the TPS yield, suggest about how we fundamentally value capital, how we perceive risk, and how much we prioritize the future versus the present? The story of interest rates, it seems, is still unfolding, and it continues to hold up a fascinating, if complicated, mirror to ourselves.